On the court or in the markets, performance is everything. That's why Anzo Capital is helping to power your trading game. Now official partner of the Phoenix Suns.
Hello there, traders. Welcome to today's webinar. Today we're going to be talking about the truth about stop hunting, and we have our favorite co-host with us today, Lindsay, who's going to be helping me dissect this myth. We're going to be going over from a retail background, because that's all I know. Hopefully Lindsay can give us an insight into the institutionals play of how they look at stop losses as well. But we're going to be basically trying to tear down this myth about stop hunting and hopefully give traders some confidence that their broker is not targeting them, not singling them out, and the market is not trying to necessarily chase them and try and knock them out before the trade moves. And I mean, we've all experienced a bit of, I guess, being stopped out before the move goes, which can be very, very frustrating. But hopefully I can show you some tools as well today that you can use and take away that will help and potentially improve that for you. But before we get into it, Lindsay, how are you, mate? How have you been? It's been a while since you've last done a webinar. Are you?
Yeah, it feels like a while.
Confident today?
Yeah, like I'm excited to be here because it has been a while. But also, I mentioned to you before that I think this could go in so many different ways. And actually, I think there is a lot that I'm going to take from you in this webinar as well. So I'm interested to see where this goes.
Yeah, I mean, when I thought of this topic, I must admit, obviously we've been talking back and forth as well about kind of, you know, breaking down some myths in the markets and stuff. And obviously I don't have that institutional background. So I've always wondered how institutions think about stop losses. Like, do they have stop losses in place? Do they, or is it almost like, I mean, they must do, right? Is that,
Yes. So I mean, there's so many different ways to approach this. Let's knock out the obvious myth here, and I think this is one that I touched upon briefly at least once before, like maybe even in our last webinar. So you touched upon it as well. A lot of people think that we as the broker, we go and look for your stop losses and then we manipulate price in order to trigger them and steal your money, which is usually a very small amount in the hundreds. That's the myth. That doesn't happen. Spreads widen for many reasons. And as I mentioned in my last one, two of the obvious ones are when there's a big news announcement about to come, the risk will increase. So people will naturally widen their spreads. This applies whether you're an options market maker, which Susquehanna was the first corporate firm that I worked in as a trader. Also, as a Forex broker, technically you are like a market maker as well, giving bids and offers. So spreads can widen because your liquidity provider also widens their spreads to react to a news announcement that's going to provide higher risk. On top of that, as I mentioned before, sometimes like at the leading into the news announcement, we will just pull our quotes entirely. So maybe for the first 5 minutes of the day, the last 5 minutes of the day, and 5 minutes either side of a major news announcement, we will just take our liquidity out of the market. So you can see what happens is, if one market maker does this, then it will have a small impact on the market. But if, say, even 20% of the market makers in the market do this, then what you're going to see is the spreads widen, and that will trigger stops. And this has nothing to do with people deliberately manipulating them. That's just something that will naturally happen around high risk movements. So let's knock that one out of the way first. That's not what we're talking about today. Is that fair to say?
No, absolutely. But it's still interesting for me to know.
Yeah. Now, as for the question, do you have stop losses? So I think one of the main pieces of advice for anyone who's starting trading or even experienced trader is, if you think about your little trading window and you've got, you can put in a stop loss or you can put in a take profit. And some people use none, some people use both, some people use one. But if you are only going to use one, it is the stop loss that you should be using over the take profit. The stop loss is far more important. Now, you asked me whether I use them, and I think the way I phrased this before is I use, I guess I'm going to say, a mental stop loss. And you're going to find out, I think, when we start talking about this more today, and as you start getting more in depth, you'll see why I don't always put it directly into the system, because there will be times where I don't want it to be triggered just like that. But you should definitely always have an idea of where you admit defeat on a particular trade, where you say, okay, the price has gone to here. If it goes to here, I'm wrong about it this time. Doesn't mean you're wrong every time, or you can't do the same trade tomorrow, but I'm wrong about it this time and I want to cut my position here. So whether you have it in the system or you've got it up here, there should always be a stop loss ready. So I always have one ready. And I guess before I turn that to you, the last thing I would say is a lot of this, or how tight you put the stop loss, is very dependent on your trading horizon as well. So at the moment, some of the money that I manage for clients is it's in more medium-term things. So it's actually not short-term Forex trading. It's in equity ETFs. So because of that, I can afford to wait a little bit. I don't have to trigger the stop loss straight away because it's more medium term, so everything can take its time to unravel a little bit more. I don't have to be quite as precise or quite as tight or quite as quick with triggering them. So you do need to factor in what sort of trader you are, because if you're a day trader, you're holding positions for minutes, then you kind of do have to be quite tight with your stop loss. Otherwise, you are just giving away a lot of profits and or increasing losses for no reason. But I'll hand back to you and let's see where this goes.
Yeah, no, that's absolutely fair. So let's get into a little bit of the presentation, because you've covered off quite a few of the points that we were looking at, and we're going to be talking about a lot when we go through it. But they've got a couple of viewers watching at the moment, so hello, welcome to the webinar. We're going to be talking about, do you get stop hunted? Is it a myth? And yes, we believe both that it is a myth. Short answer. But we're going to show you some tools of how you can potentially prevent yourself from getting cut earlier than expected. And one of those things is, you get in a trade, it gets clipped, it gets taken out, it reverses, right? And that has happened to me many times in my trading career so far. And it definitely happens a lot more to beginner traders, because a lot of the information and education that they receive is, and when it comes to kind of like where you place your stop losses, isn't necessarily I'd say, very put out there subject, right? Because that doesn't sound sexy. It doesn't sound like, oh, I want, I'm going to do a course on stop loss management or whatever. But it's probably one of the most important things that you could think about. Like you said, you use a mental stop, and I use kind of a bit of a hybrid of both, because I am very good at cutting losing trades very early. And I have a kind of question system that I do, and I go through and I say to myself, like, whenever I'm so once you're in a trade, obviously, the more time goes on, the more data you have. So the more information that you have to be able to make a more educated decision on what potentially is happening in the market. So I always have a stop that is based off of ATR, which we'll talk about in a little bit. But I also have kind of like a mental stop where I say to myself, has anything changed in the trade? If something's changed, from it, whether that be from a macro perspective or a technical perspective, then it's okay, well, technically, maybe it has broken through this resistance or whatever. That to me is not a positive sign, just from looking from my data. So I am well within my rights to cut this trade, because I know that 80 to 90% of the time that this happens, I'm going to get a full stop loss. So I've got that kind of, I won't say necessarily, this more mechanical system as well of like, okay, well, if something changes, I'm gonna cut that trade. But I'm pretty sure everybody that's traded has gone through this situation where they feel like they're getting targeted because they've put their stop loss below some level of support, and prices just whipped straight into it and then took off to the other side. But I guess from an institutional head, is that the market going to grab the liquidity, right? Does that happen?
It's yes. So let's use like the very obvious one. So there's a very obvious support, let's say, or it happens to be around a very whole number, like say exactly $10. So yes, people put their stop losses there, and for that reason, people in the market are quite aware. When I say people, I mean the big players in the market are aware that that's where it is as well. So some of it, it's a yes and a no. So some of it is simply because if everyone puts their stop losses at the same area, there's a cascading effect. So once one gets triggered, it ticks down, it triggers the next one, it triggers the next one, and because there's a whole bunch there, it will look like someone's gone and manipulated it, but really all it's done is that the first domino has fallen, and let's say it falls all the way down to $9.90, and then suddenly pops back up to $10. So you'll quite often see something like that. That's the no. But the yes is sometimes there will be algos that deliberately target these areas. So they'll just be putting through little sell orders here. Let's just put a little bit here. Let's try this. Let's try this. And then they'll know that at some point it will trigger, or sorry, at some level it will trigger. And then they'll have, say, a limit order waiting, say, 10 basis points below. And the idea is that it will trigger all the way down to that. Limit order will get hit, and then it'll come back up. And this could happen just like that in seconds. And there's a quick 10 basis points taken there just for a very minimal investment of like, let's just try 1 unit here, 1 unit there, 1 unit there. So there are definitely algos that do this. And then there'll be other algos that know that those algos exist that try to take advantage of the other side, and so on and so forth. So absolutely, it is happening in the market, just not in the way, as we said, not in the way that brokers are trying to steal their clients' money by triggering them.
Yeah, exactly. And that is the thing we're going to be talking about, is stop hunting real, and the myth that we're exactly talking about is the broker targeting you as an individual, trying to deliberately run that stop loss. And it just doesn't happen, right? I mean, granted, there may be things out there that can show you where there might be resting liquidity. Like, I don't know, have you heard of something called Bookmap?
No, but I'll let you explain it, but I think I can take a guess what it is. But
yeah,
go ahead.
Bookmap is basically shows you where rested limit orders are in the book.
Oh, yeah, sure.
And then, so a lot of the times you'll see a lot of limit orders being placed above like a swing high or a swing low. And then the market will tend to gravitate towards those larger liquidity pools, sort of thing. And that's the kind of theory sort of behind it. So it's not necessarily like your broker targeting you for that specific, it's the market being the market, right? It's the market doing its thing. But we're going to try and show people how to overcome that a little bit today. What I want to talk about as well is some data.
Wow, that last chart was amazingly like exactly what I'd said. It's almost like we prepared this. I honestly have never seen these slides before, so that was amazing.
That's why I glossed over it pretty quick, because you heard it. Like, I was like, maybe I should have moved to that slide before.
Well, I'm glad we're on the same page. Anyway, I'll let you continue, but that's a good sign.
Yeah. Well, I thought I'd get some evidence for us, right? Because I love facts. I love looking at different things and trying to bring, some light to it, just so that people don't feel like they are being, specifically targeted. But there is actual data out there. So I found this little report, and it's a 2005 New York Fed study which analyzed major banks' full order book, right? Out of 9,655 stop losses and take profits across 3 currency pairs, right? So 10% of those stop loss orders sit exactly at rates ending in 0.
10%, wow.
Yeah, round numbers and not random ones. So when we talk about, and I talk about psychological levels a hell of a lot, and I talk about whole numbers, quarter number, half numbers as like areas to just watch out for. Now, my theory, and I guess it was always just a theory, right? It wasn't necessarily hard copy. My theory was that because the market didn't used to be necessarily electronic, it used to be in the pits. So people would have to shout their price, I guess, of where they wanted and X, Y, and Z. So it was easier for them to shout those whole numbers, round numbers, quarter, half numbers than it was to shout very specific figures across a room, right? So my theory was always from that makes a little bit of sense in my head that these levels are going to be targeted. But when I saw this data, I was like, well, this is quite interesting, because it just shows you that even major banks' books have a 10% stop loss orders sitting exactly around those whole numbers. We've also got some more data here as well, which is just basically talking about the faster price moves in 15 minutes across a round number is usually 2 times the amount. So that's obviously price spiking around those kind of levels. And 24 to 63x move large standard deviation prices than the normal distribution you would predict. So that was from the C. Osler Stop Loss Orders and Price Cascades in Currency Markets, which was a report by the Federal Reserve. So what do you make of that data? Do you think that's interesting for you to read? Because obviously you've had that institution.
Yeah, it is. I mean, it exactly matches the anecdotal evidence that I've got. So this is like hard data. The first one is very amusing. Like 10% is just, to me, way too high. Like,
is it?
Well, as in, like, you think people, it's amazing that 1 in 10 people are doing this. So I'm sure you are going to touch on this later. But one very obvious way to get yourself out of this is do not put your stop loss exactly on the whole number. If you've got like a very strong support level, don't put it exactly on that. Like, give yourself at least 1 ticker buffer, at least one.
just one.
Yeah, just do something, but don't put it exactly there, because that just makes it too easy.
Yeah. So which comes on to my point here, which is that round number in sort of clustering and those whole numbers, those psychological numbers. Again, very easy to remember. So this is why this was my theory. It's very easy to remember. And the fact that is then backed up by data is pretty crazy to see. But, so it makes it easier for somebody placing that order to think, even when I look at placing a trade myself as a retail trader, I look at my stop loss, I think about, what's easier to type in my keyboard sometimes. And then I move it around a little bit, and I just think like, what? And then come back to, I can't put it around that whole number because that is a target, a potential target for people. So yeah, always talk about that psychological level and how you can't be placing your stop losses there. So that's nice to see the data for that. Another one obviously is the swing lows and highs. This is something that I think is probably more common in retail trading than anything else. Is as soon as they've entered the trade, they're putting their stop loss just below a swing low or just above a swing high. And again, that is very obvious levels for price to go into, right? So, even if I just bring up an example of what I've looked at sort of recently in a trade that I've done recently on cable, which was looking at the market profile. Let me just bring it up. So basically, let me see if I've got a pen tool available in here. So this is where I got short on cable. Basically, just from a quick sort of technical breakdown of this, I was looking at the fact that we'd broken down through the previous day's profile. We're trading under the previous day's value area. We also had a sort of low volume node through here as well. And it was also the value area of the day. So price was just kind of bouncing between these areas here. So price came up, rejected in and around that point. So I ended up taking a short position down into what was at the time the point of control of the day. And also I used the initial balance, so the initial balance of the day. So that from a technical perspective was a great trade, but stop loss placement was really important to me for this, because one, we have to think of reward to risk, and two, we've got to think of not having too much of a wide stop. So for me, making sense was just putting my stop loss just above that swing high there. But when I look left, we do have this cluster of highs as well. So if I was wrong, there could have been a possibility where price rallied above those highs first before seeing that continual drop to the downside, right? So you have to weigh up that sort of reward to risk ratio, and try and figure out where you're going to put those stops. Sorry, Lindsay, I'm getting a little bit of feedback. 1 second, let me just...
I've listened, so...
Yeah, you're all good? 1 second.
Yeah, I can't hear it.
Let me try that. Let me start speaking now. 1 second.
Still fine on my end.
Right, let me just I might just reduce my mic volume a little bit.
Yeah, I'm just checking that I didn't accidentally switch something on, but I don't think I have. No,
you're good. So yeah, essentially. Oh yeah, I'm getting it quite bad. 1 second.
I'm hearing nothing on this end.
Right. What I might have to do is just while I'm talking, I might just have to mute you and then put you back on. Is that all right?
Yeah. Yeah, go for it.
Right, sorry. Let me try that. Yeah, okay. Yeah, just move your hands around, and if you want to say something, just wave aggressively at me. But yeah, so what I'm kind of coming to the point of here is the fact that, my stop loss was above this area here. So it was trading at 135.51, which was just above that 135.50 handle, which if we look at 135.50, that was also tapped. So if we're talking about kind of those whole and half numbers, that is one of those half numbers that gets tapped into. But one thing that I always like to do as well is when we look at a chart and we place certain numbers on a chart, I like to look at how we can round up those levels. So if we look here, this is 136.40. If we look at sort of the whole numbers and just type one in. So let me just change this to 136, for instance, and just click OK. We can see there's a lot of action around those psychological numbers, right? Which is something that obviously if we were looking to get short in and around this level, for instance, thinking that price was going to move lower, putting a stop loss at 136 just puts it straight in the way of what we could be looking at. If we look at other ones as well, if we look at like 133, something like that, wherever that has just gone. One spot 33 might have helped. I think I just sent it to 133. Again, the market comes into that level and price spikes around it. There's always a little bit of a reaction around those types of whole numbers. So it's important whenever you're looking at your particular trade, it's how or where am I going to position my stop loss? And is that stop loss in conjunction with one of those whole numbers, essentially? And is it above a key high or is it above a key low? And if it is, how can we extend it out? And I'll show you a little bit later of how you can use an ATR to cover that off as well. But this is the theory behind it. And this is what I wanted to include, essentially, was a little bit of an image of what the sort of liquidity grab is as well. And you see it loads of times, across the charts. Again, if I'm just kind of looking at pound here, and I can see one pretty clearly here where we have, all these clusters of lows in here, and the market comes and takes that low before seeing a move back to the upside, right? Essentially, is that a liquidity grab as well, right? As price come down into that level, took that low, rejected, moved higher. Look at this instance here. Let's say you were shorting from the moving average crossover, a retest strategy. You put your stop loss above the swing high there. Price goes in your favor. You think, great, this is amazing. I'm onto something. It comes all the way back up, takes those highs first, and then we see a big move to the downside. So at these things, looking at your stop losses above those kind of like, let's say you were long in here, stop loss below the swing low, you're essentially putting yourself in the way of what potentially could be that target for those larger traders, those ones looking for the liquidity in order to see some decent moves. So, Lindsay, I'd love to get your thoughts on that as well, and how you've experienced that, or if you've experienced that, and how that helps maybe like place your stop losses in those instances.
Okay, so I'm back on. Yeah.
Yes,
So
yeah. Don't worry, I've got the buttons down. You're all right. Yeah, you're good.
all right, you're all over it. I think I can touch more on the second part of your question, just because this doesn't happen to me that often, just because of the nature of how I like to take trades. I tend to prefer to target breakouts as opposed to areas of support or resistance. But I think was it the last webinar where I talked briefly about the three-legged, the breakout, the pullback, and the resumption. So in terms of how I approach stop losses, I kind of do the same thing, but just from a different perspective. So if you think about it as, let's say we have a long position, so we're worried about a stop loss being triggered to the downside, so a breakout to the downside, showing that we're wrong. The reason I might have just a mental stop, and by saying a mental stop, I just mean I know where it is, I just haven't typed it into the system, is because if it breaks below, say, that nice whole number, let's use the $10 again. If it breaks below that, so let's say in this example here, that dotted line's at $10. What I want to see is that it crashes below that, it will bounce back up. Like there's always going to be some sort of pullback, and I explained why in the last webinar. But then I want to see what happens after that. Does it just go back above that dotted line and resume the move, or does it resume? So that breakout, pullback, resumption, this time the breakout's to the downside, where your stop loss would have been triggered if you'd had it in the system, and then it pulls back up. If it resumes, then you can say, okay, this is where the stop loss should be not triggered, but you should be enacting the stop loss, because that is a genuine move below that level. So you see the resumption, and then you go, okay, fine, I'm wrong about this particular trade. You cut it. But by making it only a mental stop, you've given yourself that ability to at least take a breather and see whether it is a genuine resuming trigger below a certain level or above a certain level if the trade's in reverse. So you can see whether it's that, or it is just one of those temporary what you call liquidity grabs before heading back up in the direction that we want it to go.
So I guess in your trading then, like, or when you're looking at a position in a particular market and you talk about the sort of, consolidation, breakout, resumption, are you, in theory, are you kind of avoiding this potential liquidity grab by letting it happen first and then?
Yes.
Yeah. Okay.
It's basically, where the stop loss is, but you kind of don't want to trigger it straight away in the same way. And again, you want to be consistent about this. When you're entering a trade on a breakout, I think we both agreed you don't just take it the moment it breaks out. What you want to do is give it time to breathe. Let's see it break out, see the pullback, and then see it resume, and then take it there. So I take the same approach with the stop losses, just it's happening in reverse and it's a different perspective. But you do have to be very careful with it, because if you take this to the extreme, then this is where people have the temptation to just lower their stop loss a little bit, and suddenly your stop loss is 20, 50 basis points below where you initially had it. So you do need the discipline to be able to follow through on this. So I am saying genuinely see whether it resumes, not just use it as an excuse to change your stop loss because you don't really want to get rid of this trade.
Yeah, no, fair. That's quite interesting then, because it's almost like when I was looking at the chart then, and I was looking at the price coming above those highs and lows, and market is kind of like moving in particular ways. You're essentially waiting for that to play out first before then trying to get onto that move. So that's quite interesting to think about as well, because it almost eliminates And it can almost be a method of how somebody can eliminate that liquidity grab. If they think that the liquidity grab is going to be at that particular point, they could almost wait for it to potentially happen. Because if it doesn't happen, price is going to break out anyway, right? And move regardless. So yeah, I quite like that, actually, thinking about it in that way, and thinking about how maybe waiting for that condition to be met first before taking the trade can also be a big help in preventing you getting kind of like stopped out on those liquidity grab moves. Right, so let's get into some practical stuff, right? And this is something that I think can really sort of help traders, right? Now, a lot of my trading is swing trading based. A lot of my, I do often do a couple of day trading things, and that's just because I, am very, I was just saying very versatile, but sometimes it can be depending on what the market is doing, right? So if there's a lot of movement going on, sometimes I like to go to the lower time frames and try and trade a piece of it. But I'm going to show and go through one of my old swing trades. So let me just set it up here on the chart, and then I'll bring people in. Let me go to the right time frame, and we can have a little look at this particular move in here. Because with this particular stop that I used, it was very much putting my stop loss in a place where I could have a good reward to risk, but also it being below a whole number. And also we're going to talk a little bit about how we can add ATRs as well to the chart. So let me just bring on this one. Before I get into the ATR, let me just show you this particular trade that I did on euro dollar. It's a little bit hard to see. I might have to change the color of the trend line here just so you can see the trade tracker a little bit better. But essentially was looking at buying euro US dollar. We were trading towards, again, a psychological level, which was down towards this kind of 115.25 handle in here, just through there. And, this is almost arguably what we were kind of talking about in terms of like trading the breakout. And there's a couple of different ways we could have traded this. So we had this kind of horizontal support level. There's a lot of price action down here. The market then broke out, and then the market started to just drift all the way back down towards this key level of structure again. So if I was just trying to trade the lows of this, it wouldn't have been a good time for me, right? The market was forming that kind of double bottom pattern. You can see it almost had that liquidity grab. If you look left, it takes out these lows over here, and then it breaks out. It trades above the 50 moving average, which for me is one of my swing trading setups. Once I have everything in place, once I have the why I want to be involved, the conditions around it, this is one of the strategies that I like to use. So I ended up buying here. Now, when I look at the stop loss, it is typically below that swing low, right? It doesn't have necessarily a lot of breathing room for this particular trade. And that's because we had the consolidation first and then the breakout. I think if I was looking at this and price came in, gave me, most traders might have just looked at that initial sort of stall in here, thought, oh, this is a good level to be a buyer from. I'm going to be, buying on any bullish candlestick that I see. Then, they might have took this kind of like bullish setup through here, put their stop losses directly below the swing low, and then get taken out before the move goes, right? Instead, like how you were discussing earlier, waiting for that consolidation to happen, then a breakout can almost be a stop system that you can use, because you're almost getting a little bit more confirmation before
exactly
moves. I mean, price did then retrace. So this is the system that you talk about, and then start moving higher as well. But in this instance, I took the breakout trade here with my stop loss just below the swing low. And also, I like to look at the psychological levels as quarter number, whole numbers, and half numbers. So, you know, having my stop loss just here at the 115.10, just below 115.10, so it was around about 115.09s, kind of helped me kind of stay away from that whole number as well. Question coming through. Thank you, Bishop. How do you ascertain a consolidation at price points? For me, it's just a build-up of consolidation. So it's just price moving sideways at that particular time, right? So you'll see these obviously different across different time frames, and some of them can be a lot larger and some of them can be a lot shorter. But for me, this is what I look for, and I call it fair values, where price buyers and sellers are almost agreeing with price at this point. And then obviously some catalyst has driven price away from that. But for me, that is where big sort of volume can sit. Something that you can use. So I use things like market profile, volume profiles, and things like that. The one thing that you can use is you can look at things like market profiles and things like that, and I'll show you where those kind of large build-up in volume takes place. And then you can see obviously price comes back to that large volume area before moving on. So from my perspective, I always just kind of look at periods. You know, a consolidation is basically just a short-term range. It's where value gets built up, and when price moves away from that value, it can come back, test it, and then, you know, continue to push on its way if it wants to. Obviously, it depends if those buyers and sellers are still around at that point. But you can see them all over the place. You can start spotting them everywhere. Like, you know, just a little bit of sideways movement. You know, price breaks out here. You know, you could argue there's a little bit of sideways movement there before price breaks out. So these little pockets are kind of areas where those orders are potentially being built in the market as well. I don't know, Lindsay, if you have a different perspective on that.
No, it cannot be explained any better than that. So I'll just leave it there.
So great. So let's move on to how maybe I could have done this trade differently, right? So, and this is something that I always like to look at, is how could I have made this trade different if, you know, I was going to use some tools that can help. So let's say you were trying to take this trade here, right? So let's say I'm going to try and map this out a little bit differently. So somebody might be able to kind of, you know, save themselves from being stopped out aggressively at this point. So let's say you took the initial trade, which ended up seeing price kind of spike down a little bit before moving higher. I'm just going to put on a sort of fake risk reward tool, right? So what a lot of people would do essentially is wait for price to kind of come into this area and try and break out. Or let's say you want to take my 50 moving average strategy, right? We have one over here. Now, if I put my stop loss just below the swing low, that's 17 pips. That's not really that great, right? If we want to look left, we could potentially put it down at this low here, which is a little bit better. But ultimately, what we can do is use something called an ATR, right? So if I just bring this in first, an ATR is basically what's known as the average true range, and it can calculate over a certain periods to give us a broad kind of measure of essentially volatility of that pair or of that asset. And what we can then do is use a multiplier of that and add it to our stop losses so that we have a buffer of a certain ATR. So some of the ones that I've recommended here for scalping is 1.5% ATR, which basically just means the ATR that we're using, 1.5 times that. For day trading, 2 times ATR. For swing trading, 2.5%. And there's other ways that you can use it as well. So to add that to your charts, and I'm sure Lindsay has an ATR kind of stop method as well, I hope, maybe.
No, it's uncanny actually, because I actually try not to put too many indicators on my chart. So I only have 2, but one of them is one called a Keltner channel. And like so many, yeah, and that uses a moving average, and the way it measures volatility is with ATR. And the reason I like it is because ATR is actually so easy to understand, as opposed to some of the other the other ones, where it's like a very complicated method that they use to calculate the volatility. But ATR is just, it's actually quite straightforward, and you can just very clearly see, okay, add this amount above the moving average, the same amount below. There you go, widens, narrows, widens, narrows.
Yeah, absolutely. I'll be interested to see if you could get a example of that, of the counter channel method.
Oh, I can. I don't know if I share my screen, it's on every single one of my charts. So
sweet. Yeah, let's do that in a minute. That's great. Because I'd love to see that method as well. But like one of the methods that I like to use, especially when I'm swing trading, is by giving myself a little bit more breathing room for the trade, is by applying an ATR to the screen. And what I look at is what is the average sort of ATR over the past sort of few days, or what is the average ATR of the time of me taking that particular trade, and then can I add that level, depending on the ATR kind of multiplier, so let's just, for argument's sake, that this is 10 pips the ATR, right, at this particular day, this particular time frame. I would look at that and say, well, I can't have a stop loss within that 10 pip area because it's within that volatility range. So as a swing trader, I would times that by sort of 2.5. So I want at least a minimum 25 pip stop. But what I like to do is add that to the original trade. So if my stop loss is going to be 17 pips, or if it's going to be sort of below these lows at 30 pips, I like to add that amount of pips onto a stop loss, right? Just to give me, again, that little bit of extra breathing room. So let's say I'm looking at an extra 25 pips on top of my 15 pips. I'm looking at around a 40 pip stop loss for that. And that gives me a lot of breathing room for my trade to be able to breathe, essentially. Now, downside to that is obviously your reward to risk goes a little bit higher, right? You've got to give a little bit of that back. But the positive side is that you're more likely to stay in the trade in line with the volatility of that particular market. Okay. Now you can use it per time frame. You can go to the daily chart and have a little look at the daily range at the time as well, which is something that I do recommend you do. But it's just a quick example of how somebody can use an ATR just to give themselves a little bit more breathing room to the trade. Lindsay, I'd love to hear your thoughts on your counter channel. Could you maybe show us a little bit of that?
Yeah, actually, now that I've thought about it, so I can certainly show you, but I use it actually to help me get in and out of trades. But it's not. I actually use it for stop losses. So I don't know if it's going to derail us too far from what we're trying to focus on today. I can definitely still show it, but I don't think it's quite in the same vein as what you're talking about.
That's fair. I mean, does it help you with your mental stop in any way?
No. So interestingly, that's not the answer you wanted, but
it's not, but it's okay.
Yeah. No, I actually use that indicator more to get myself confidence when I'm going into a trade. Basically, you want to see it going into the upper or lower Keltner channel, or if it's even just breaking out above or below. But in terms of stops, I tend to, again, just do it a bit more visually. And again, I'm not suggesting that everyone just go out and do this. It's just because I've had a lot of practice seeing these play out again and again. So I just have an idea of where I want to put it. And also, you touched upon like certain factors about 5 or 10 minutes ago as well that absolutely matter, which like one of them was when you have more consolidation, or you see it consolidate around an area where it already consolidated in a previous time period. In that case, it is actually valid to be a little bit tighter with it because, like you said, you have more confidence in it. So if it breaks through that, then you should have more confidence that it is a genuine breakout against you. And also, a lot of the shakeout would have occurred in the previous period. So you have a little bit less of an issue of those dominoes falling and then suddenly bouncing back up because it already had a chance to do that in 1 or 2 or 3 previous periods.
Yeah, and like in an example like this one, it gives you an opportunity to kind of look at the data that you're getting and decide whether the trade is still valid or not whilst you're in it, right? If you have a super tight stop loss and you get stopped out immediately, your brain might think that's a bad trade, that's a bad setup because I've lost a trade,
Yeah, sure.
rather than it being from a point of view of actually, it's not a bad trade. It's just that I've got stopped out and now I'm trying to, either revenge trade and get it back, or it lead to a lot of different psychological factors after the fact. But I always ask myself the question, like, has anything changed within the conditions for me to want to get out of that position? And if it has, then I can start to kind of, get out of those. But if it hasn't, then I have that confidence to hold it a little bit more. I have the confidence to be a little bit more aggressive, maybe even add into a position if I see the right things, going on. So but I would love to maybe dissect that another day then, on how you look at entering the markets and stuff like that. Maybe we can have that in a different.
I'm sure we could talk a long time about that. So that'd be great.
So another one of those things that I like to do is also look at market profile. That's kind of very similar to what we just talked about in terms of those consolidation areas. And this matters a little bit more to me on things like day trading and stuff, because I want to be able to put my stop loss in a place where there are certain barriers of support and resistance. So if I was to go and look at, let me see if I can find a couple of opportunities around, or just kind of explain. I mean, the markets are very, very choppy the past few days, so it doesn't necessarily help with that situation either. But let me see if I can add one on, because I don't. Do you use market profile or anything? Or have you heard market profile, Lindsay?
No, that's why I'm trying to teach myself it right now. But I think you're about to explain it.
Cool. So market profile has been around for ages, and it talks about something called auction market theory, which is basically price finding new levels of value. And back in the day, they didn't have the access to necessarily to the volume. So this was actually created by a trader in the pits. And what he would do, he would manually create what's known as a market profile chart by writing out letters throughout the day, or throughout a session. And what he would do, so let's say we've got this kind of histogram on the chart now, but what he would do, he'd use the 30-minute chart, and if price had moved up a certain amount of pips, he would give it a letter, standardized letter to that. So let's say, for instance, if I just zoom in on a couple of these, so let's say, for instance, you've got this little period through here. So let's say the market went up by sort of 10 pips. He would be like adding A here, and then the next half an hour candle started. So we'd do BB, and then he'd say C, and then he'd sort of like this, right? And then you get so on and so forth as soon as kind of like price deviates from a certain level. And what he was trying to do basically was find where the price had traded throughout most of the day. So I have a point of control, which is the most traded level through that area. And that's because of this consolidation here. It's because price spent a large majority of his time throughout this area. So when I talk about that, that's to me is fair value. Market buyers and sellers are agreeing with this price, okay? And then the market may go and search for other areas. It may go and try and search for value, fail, and then move to the other side, try and find value elsewhere. But that's how I kind of like see markets. They're always trying to find where the fair value for that price is meant to be. But they can also be really handy when you're day trading to look at them as sort of areas to place your stop loss, right? So one of my favorite trades is to trade from the value area highs or the value area lows. And the reason why I like to do that is because usually they are edges of, it's called the edge of the ledge, essentially. And the orange level is where 70% of trading has taken place throughout the day. right? And then obviously the gray zones are kind of like those outer areas of that. But sometimes they can really act as very strong levels. So for instance, on this day here, we broke out of value but failed, came back into it, and it acted as support at this point. So when I'm looking at that and trying to combine it with the current point of control, the current market profile of that day. So let's say I wanted to take a trade in and around this area, right? Market has come back to the previous day's value area low. Market has come back, retested it. I could look at that as an area of potential entry on a lower time frame. And what I'd potentially do is look at where the low volume levels are versus the high volume levels, right? So I can see that there's a low volume level in and around this area here. And what I could potentially do is put my stop loss below that instead of trying to put it below the swing low at that point, because I know there is a potential barrier for that resistance, right? If we look at this previous day here, we consolidate. So again, we have that kind of fair value situation going on. Price breaks out, comes back up, retest that low volume node in there, and then the market continues to push lower. And that's a very, this is almost like visualizing what we talk about in terms of the breakout, the consolidation, and the retest. It's almost like a visual way of seeing that move, right? So obviously the market profile tool's playing up a little bit, but you've got this kind of block there. Let me just move it down. I want to start behaving itself. There you go. So you've got this kind of like block here of consolidation. Price breaks out, comes back to the value area low of that area, and then sells off from that point. So that could be obviously like the entry, but also could be great for our stop losses, because we can say, well, that is a very strong level of resistance. We can put our stop losses just above those zones, or just below the low volume areas, in order to try and protect ourselves. So that's another method that I like to use. It's not as popular. I don't think it's as widely used as what most people do in terms of ATRs and things like that. But just another little one that I wanted to show the guys. We've had a few questions come through. Let me just move to the next slide before that. Let's see if any of these questions. Bishop asks, with smaller accounts, one seems compelled to tighten their stop losses. How do they manage that, especially if we have to wait for the liquidity grab?
Is a smaller account just a lower funded account? Is that?
I assume
what
so,
you mean, Bishop?
I assume so.
This is going to be a very blunt answer, but it's the amount of your account should not make any difference or have any impact on the placement of your stop loss.
I was going to say, it doesn't, this is almost like one of those things where it's like the process needs to be above the capital amount. So it doesn't matter what capital amount that you're trading, the process should be the same. Obviously, if somebody has a smaller account, they want to make more money. So they're compelled to use tighter stop losses. But that shouldn't necessarily be the way, because if you have, the way I always looked at it was, yes, when I first started, I might have had a small account, but if I perform really well, maybe I could get investment. Maybe people could invest into me, or X, Y, and Z, or I can go to funded places and ask for investment, X, Y, and Z. As long as you have the process there, obviously the amount will kind of matter still, but as long as the process is there, they might be able to give you a chance at least. So that was always my kind of thoughts on it. But I also thought that if you don't nail the process on a smaller account size, you're not really going to nail the process on a bigger account size. It kind of actually makes me think like, and if Bishop, if you're still here, it'd be great to get your answer to this, but do you think you would use less tighter stop if you had a bigger account? Like, is there a theory behind that then, that people have large capital, they feel more comfortable with having a bigger stop loss? Or is it just because they don't need to make as much from the trade, if that makes sense?
While I give Bishop a chance to respond, I think the bigger consideration here, it's less to do with the tightness of the stop loss, and it's more just check that the size of your trade actually makes sense relative to the amount of capital that you have in it. Because again, we have very little info to go off here, but one of the reasons people might feel compelled to have a tighter stop loss is because they're just sizing their trades incorrectly. So if the size of your trade is too big, you might feel that you need to have that stop loss a little bit tighter if it goes against you. But then that's just a matter of scaling. So when your account gets 10 times as big, your stop loss should still be there. It just means that it should be still at that ideal level wherever you find that ideal level. It's just that the size of your trade will be 10 times bigger as well.
Yeah. So Bishop says, yes, I think so, because they can risk more, which it's kind of counterintuitive, really. It's like, yeah, it is hard.
You risk more by having a larger trading volume.
Yeah,
that's how you risk more. It's not by having a larger stop loss.
Yeah, you're just risking more naturally because the percentage size is bigger of your trading account, more than anything. Festy asks, is it wise to get in immediately when you get stopped out due to a spike in volatility and you see that trade will still go your way? I think this might be about the liquidity grab. But, again, that depends on your rules and how much you are risking, because you can't guarantee a liquidity grab per se. Like, it's just because prices spiked down, took it out and moved higher doesn't mean that it's still going to continue higher. You still have to make sure that you risk appropriately in that sense, as well. But moving on, I just wanted to talk about a little bit about volatility. And Lindsay, you actually talked about this earlier, as well, in terms of when a news event can occur or a large session could be coming into open, sort of like the US Open or whatever. Volatility can typically rise. So how do you account for that when it comes to a stop loss? Let's say you wanted to put on a trade, would you wait for an event to happen first, or would you make sure that you're away from an open, or what? Is there anything that you try and avoid? Or
so many yeses in that. So if, again, as we said in our last webinar, if you're trading the event, I think the two of us prefer to wait for the event to happen first and then trade the aftermath.
Yeah.
I think if you're taking the trade completely independent of the event, but the event is going to impact your particular asset or currency pair or whatever, that is an excellent reason to wait. But even if all your setups line up perfectly, that event could throw everything out the window. So that's a great time to wait, see how it shakes out, and then assess after. And quite often these provide excellent opportunities as well, because you might see the price, it will be volatile, but you might see the price go to a level it wouldn't otherwise have gone to, and then resume in the direction that you thought you wanted to go, and you get in at a much better level. And it also becomes very clear to you where you should put your stop losses, where your take profits should be. So sometimes they provide excellent opportunities because they provide more clarity.
Yeah, awesome. Thank you. Right, so let's just recap what we've talked about today. I've just realised we've been going on for nearly an hour now, which is great. These always seem to be super quick, Lindsay. Like, I always think
really good questions as well. I'm glad we got those.
Yeah, really good questions. And obviously as well, guys, if you have any more, please feel free to add some. Again, we're going to have a little bit of a bonus at the end as well. So if you stay to the end, I'm going to give you a code that you can apply at checkout as well for your trading account. So just wanted to recap, just basically say, think about, structure and where those liquidity areas could be. If it's above a key high or low, think about those psychological levels as well. Those are super important, especially we showed you those studies as well. So just make sure that whenever you take a position that you're not putting your stop loss around a whole number. That would be ideal. you can size by volatility. So using an ATR, I think, will help you, especially if you are the trader that is getting stopped out before the move happens. And essentially, it comes down to your own data. What is your data telling you? If you are getting stopped out all the time before the move goes, then consider going back and looking at your trades, applying an ATR to your screen, looking at what would happen if you applied one of those multipliers to your ATR. And if it makes a big difference, then it's something that you can look at to apply. And obviously, you can always look at how volatility impacts that as well. And also make sure that you're not putting your stop losses at very, very obvious levels. So do we have any more questions? We've had some great questions actually throughout the session, which has been really nice to have. But if anyone has any more questions, please let me know. I will get the code ready for the guys in the background. But Lindsay, is there anything that you want to add that you think we've missed today? Or is there anything that you want to add that maybe we've not thought about?
No, usually like if I have something that I want to touch on, like under the table, I'm holding out a number of fingers to go, oh, I want to touch upon this. But just then I actually had nothing out. So you actually covered everything. I think I inadvertently preempted a lot of the slides that you had as well. And again,
which is impressive in itself.
Yeah, it's great that we're so aligned on this topic, especially because at the start I said this could go in so many different ways that are unexpected, but actually it's very much in line with how I think about stuff.
No, absolutely. Which is great, because I just think for me it's actually quite nice, because obviously I don't have that institutional background. So when I'm saying these things and you go, yeah, that's exactly the same, I'm like, okay, this is great. I'm on the right. I've been doing the right things. So,
almost like you know what you're talking about, John.
Yeah. I'd like to think so. I still have a little bit of that that imposter syndrome every now and again creeps in, and I don't know why, but it just seems to get to me every now and again. But yeah, no, I appreciate that. So guys, thank you for joining today. I have got a webinar bonus for you. So if you want to claim $20 trade credit, all you need to do is contact the CX team through this email, John and Lindsay 20, or take a screenshot of this right now, send it to your account manager, and they'll apply you with $20 trade credit. We are also on the hype of getting some Google reviews in. So if you have enjoyed this webinar and you've learned something new, please feel free to go over to our Google review and leave us a very nice review. We'd be really appreciative of that. And if you have any questions that we've not been able to answer today, or if you think that of any other questions after the event, feel free to drop them on this video as well after. And I'll make sure that me and Lindsay get around to answering some of those. So
sure.
Bishop actually says, we talked about stop loss. What about take profits? So that might be
probably another hour.
Yeah, another hour. So maybe we'll talk about that in a future webinar as well. So yeah, any suggestions that you have as well, guys, drop them in the comment section. We always love feedback. And we never take anything to heart. So we appreciate that. I keep a lot of money on the table painfully. Yeah, there's a few systems that I can help you with that as well. That used to be one of my downfalls. I still remember a pound Swiss trade.
Everyone does that.
Yeah.
I've done it as well.
Yeah, like I have very vivid trades that I could probably show you, which shows you that. so yeah. But yeah, thank you for joining, guys. Really appreciate it as always. Lindsay will be back with us very, very soon for another topic. So yeah, I will catch you all then.
Thanks, guys.
On the court or in the markets, performance is everything. That's why Anzo Capital is helping to power your trading game. Now official partner of the Phoenix Suns.